happy to be here to chat with you about planning and investing in a tax-conscious manner. We're going to treat this a little bit like a survey course where we're going to introduce a variety of topics, the ones that we see most frequently. Ian and I spent a lot of time talking about what we see on a regular basis. And several of these topics, please understand that they could be, and some of them have been, standalone webinars. So we're not going to get 1,000 feet deep in any of them, but the goal is to really highlight the issues that are out there, how you want to be thinking maybe about taxes relative to your portfolio, to retirement, and maybe some of the situations where the tax consequences take a backseat to the investment decisions that need to be made. So with that being said, I'm Brad Newman. I'm here with Ian Eberle. Ian is one of our in-house tax gurus, and we're going to take you through the conversation today. So just a little bit before we dive in about Fort Pitt Capital Group. For those of you who are not familiar, we're an investment management and financial planning firm. We were founded in 1995. A few of the things that make us unique are, I think, we do all of our investing, we make all of our investment decisions, and all of our planning work is done in-house. We don't farm it out to a third party, and we're becoming rare in that sense. That is bucking the industry trend. We also take a team approach to how we work with our clients, and the goal is really there to provide a boutique level of service where when Ian and I and the other advisors at the firm are talking to clients, we know them. When they call up, we oftentimes recognize them by voice. We know what's going on in their lives. Our clients aren't a number to us. And then I think the final piece is really that we take a holistic approach with every relationship, from customized retirement planning to working with clients in all aspects of their financial lives, not just managing their portfolio. And our clients typically come to us, whoops, I think I went a little too far. I was going to say for things like charitable planning help with Social Security, intergenerational giving, just all of those things. So a little bit about our webinars. They are designed first and foremost to be educational. They're designed to touch on the areas of our clients' lives that are important to them and really leverage the expertise of the different advisors here at Fort Pitt and also some of the folks that we collaborate with on an ongoing basis. So with that being said, let's just take a minute for Ian and I to introduce ourselves. Like I said, I'm Brad Newman. Just as far as background on me, I'm a certified financial planner. I've been with Fort Pitt for just hit 20 years last year, and been working with clients for over 25 years and just helping them quantify their financial goals, get to where they want to be going. I'm located here in the Central Pennsylvania office, married with 2 children. I now like to say I've got a 2nd grader and a college senior. My 2nd grader is actually a recent college grad who is in her first full year of teaching 2nd grade. So Ian, can you share just a little bit of background about you?
Sure. Hello, everyone, and thank you for tuning in. I'm Ian Eberle, and I have a tax law and accounting background prior to transitioning into financial planning. I have a law degree, and I'm an enrolled agent with the IRS. I've prepared tax returns before in a previous life and worked in tax litigation in Harrisburg at the Attorney General's office. And so my background is really getting in the weeds on tax. How that's helpful here is that tax can often move the needle more in some cases than outperformance in investment returns. And the way that I look at tax in the holistic approach to wealth management is if we could save you money in taxes this year, next year, the year after, those savings can compound as well. And so when we talk about compound interest and growing the portfolio, tax savings and being tax efficient is a necessary component of that that could really move the needle long term. And we could model out what that would look like for you if, hey, if we just shifted these few things around, we could save $10,000 a year in taxes. What does that look like after 15 years? It's a big deal. And so that's the way that we approach financial planning, tax planning, and that's the background that I bring to this webinar and to the firm in general.
Excellent. As you can tell, Ian's the smart one of us.
We'll see.
All right. Ian, do you want to walk through some of the housekeeping items that we're gonna?
Sure. So if you're on a computer and you're watching the webinar here, there will be a couple controls. So you'll see a questions area where you're able to click on that, and then you could type in a question and it'll send to us. And at the end, when we do the Q&A, we could go through the questions and we'll read your question and give you an answer. And if you're on a computer, you could see where the questions area is here. And then you'll see a handout section that you could click on the handouts and download that also. All right.
All right, and just in full disclosure, if you see us kind of glancing away here and there, we're kind of checking on questions. We're not trying to multitask on you. And we're certainly going to do our best to get to all the questions in the Q&A portion, but we'd certainly be happy to chat privately afterwards, especially if there's something that's a little bit more personal, maybe a little bit more sensitive that we don't, maybe you don't want to get into in a broad audience. So let's dig in, Ian. Let's start off a little bit more broadly and talk about kind of the concept of pre-tax savings versus after-tax savings. I know most all of us have been conditioned over our lives that you want to defer as much as possible. Defer, 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 defer. And it's really nice to get those immediate benefits of tax deferral. It's also nice to get that ongoing tax deferred growth. But tell me just a little bit about kind of the importance, or if it makes sense, to develop some after-tax savings.
Sure. It makes sense, just as in diversification in investments, where you don't want all your money in one fund or all your money in one stock. You don't necessarily want all of your savings to be in one particular type of vehicle either. And so 401ks are fantastic. You contribute to your 401k pre-tax. You save money in taxes by virtue of putting the money in there. You put money in a Roth IRA, well, now you never pay tax on the growth again. When you take the money out later, tax-free. That's fantastic. Health savings accounts, 529s, there's all kinds of different accounts that are tax advantage vehicles. However, having some other options with just a standard investment brokerage account could be what everybody needs, just to have a little bit of. So for example, I've worked with a lot of clients who are millionaires on paper, who have, let's say, a paid off house and a retirement account. But if you're 40, you can't access the retirement account yet until you're 59 and a half. You can't use the home equity unless you get a home equity line of credit to borrow against it. So let's say you needed $30,000 to pay for whatever, a medical bill, you want to go on vacation, you want to do, a home renovation. You need $30,000 liquid. Having savings and investments that aren't in these tax advantage vehicles is useful in those cases when you need access to the money. And so trying to balance that and finding where that balance is something that we could help you with, and determine how much after tax should I do? How much should I do in my 401k? What should my Roth balance look like? And we could help navigate, how much in each bucket would make sense for you.
So it sounds like you're saying, number one, if you go all in on either pre or post tax, you're kind of making a bet on whether tax rates will be higher or lower when you ultimately retire. Number two, you want to build in some flexibility or some options so that you might have access to dollars for opportunities prior to when you can get at these retirement accounts, quote unquote, without a penalty. but we are going to be paying some tax as we go, as far as, dividends and capital gains. Tell me just a little bit. I kind of think of it as dollar cost averaging, that we're kind of paying our taxes as we go in that after tax account, and hopefully a lot of them while we're still working, so that when we get to retirement, we now have access to some tax-free dollars.
Yeah, yeah, and with a non-qualified brokerage account, you would pay taxes on any interest that you receive from a bond that's owned in that account, any dividends from stocks or stock mutual funds that are owned in that account, and capital gains. So if we sell something at a gain, you would pay tax on the difference between what we paid and what we sold it for. And as we do that over time, like Brad said, you're averaging your tax bill, so that way your tax bill doesn't all hit in the last year, which for an IRA or a 401k, it does kind of work that way. You get the tax deduction going in. Let's say you contribute $100. Over time, that grows to $10,000, and you take the $10,000 out. Now you're paying tax on that $10,000 as you access it in that year. With the brokerage account, it allows you to spread it out over time, so that you're not getting hit with the taxes all at once. You're getting hit a little bit as you go, and it allows us to be more efficient over time, so you're not pushing yourself into higher tax brackets when you need to access that money later. And you also have additional flexibility with a non-qualified account that you could borrow against it. And so you would have access to margin if you needed it, or a pledged asset line where you could borrow against the account value in total, which could come in handy more than you would think. So let's say you want to buy a property, you want to buy a new house, you plan to get a mortgage. If you have the pledged asset line against your brokerage account, you could go out and make offers on these properties using your brokerage line of credit. The benefit to you is that you could then be a cash buyer. And so you could be a more attractive offer than other people who are coming in with lending. Once you then purchase the property, you could always refinance, get a mortgage later, do that part on the back end, but it gives you a lot of flexibility. We have another advisor here who recently bought a new house, and he used his brokerage account margin to pull some cash out for his down payment instead of selling stocks. It wasn't an attractive time to sell. He knew that he was going to put the cash back in anyway. So if he would have sold out, paid the tax on the capital gains, used the cash as a down payment, sold his prior home, put the cash back in, now you've encountered tax consequences. There could have been market movement in that time. Using the margin loan for 2 or 3 months allowed him to avoid all of that potential problem. You just put the cash back in, margin loan's paid off, and you move on. That isn't an option in an IRA. It's only available in a non-qualified brokerage account. So again, to having some of each allows you a little bit more flexibility as your financial life becomes more complicated.
Yeah, Ian, I've done that a number of times with clients as they transition from their home into the continuing care community environment, that we might be off by about 2 or 3 months till it takes time to get their home sold. And that margin's a really great tool for a very short period of time to avoid the taxes and kind of the de facto market timing. So,
yeah.
Well, let's take this a little bit deeper, be a little bit more specific on the bond side and talk about how bonds are taxed. And this is another area where kind of the visceral appeal in paying less taxes sometimes is overwhelming to us. Lots of people aren't sure whether it's better to use corporate bonds or municipal bonds, but they like the idea. Oh, municipal bonds are tax-free. I think as you and I have been talking about this, we've got a little bit different take, maybe, that when you really take a look at, well, what do you keep? Nobody likes the idea of giving money to the government, but how should people be thinking about making that decision?
So in the decision versus when you're looking at corporate bonds and municipal bonds, really the important question is, how much do I have after I've paid taxes? If you look at just the coupon rates on corporate bonds and municipal bonds, corporate bonds are much higher. And typically we could see a municipal bond, let's say at 3.8, and we might see a corporate bond at 5%. And so then the question becomes, what is your tax rate? Because that's just a math problem now. that if you received the interest from the corporate bond at the higher rate, paid taxes on it, do you have more than you would have tax-free from the municipal bond? And typically, unless you're in the highest tax bracket at 37%, the municipal bonds haven't made sense in a while. The other problem with municipal bonds is that they could be more volatile than corporate bonds because they're lent out. You're essentially lending money to school districts, to townships, to cities. And so they're more volatile and they're longer dated, so they move more than a shorter term corporate bond, which might be more appropriate for your investment situation at the time. And so the taxability is really just a question of where is your tax rate at. And unless you're really up there and at the highest bracket, I haven't seen municipal bonds make a lot of sense recently.
Yeah, you already answered my follow-up question, which was, I typically see when you do the math, you've got to be at that 37% tax bracket, which means you're earning, what, over $500,000 a year for when those muni bonds start to make sense. Or I would say, unless you have, a very, very significant after-tax non-qualified portfolio, you've got $5 million in after-tax, and now you start to look at the cumulative on all the interest of those corporate bonds, that might move the needle too.
Certainly, yeah. And there's cases that I've seen outside of that, depending on what state that you live in. Let's say you live in New York or you live in California, and you can own New York or California municipal bonds. You could tack on the state income tax as a component of that calculation. So it really depends on your individual circumstance, but for most people, municipal bonds yield after taxes less than corporate bonds. And so I have just a default preference towards corporates right now for that reason, given where rates are. But depending on your situation, municipal bonds could make sense.
That's a great point, Ian, because we don't really think about the Pennsylvania state tax because it's pretty benign. 3.07 is not a lot.
Yeah.
And you look at a lot of our neighbors, New York, New Jersey, Maryland. I mean, you're talking about 7, 8, 10%, possibly of state tax. That's a great point.
Yeah, and just to kind of clarify that, if you live in a state that has a high state income tax, you can buy municipal bonds from that state, and then usually the states will exempt that interest if it's a bond from that state. So if you live in Maryland, you buy a Maryland bond, the Maryland bond interest is tax exempt. But if you live in Maryland and buy a New York bond, you still pay state income tax on the New York bond, but not federal income tax.
Right.
And so typically we would want to match the municipal bond portfolio to where you live, because then you get the state tax benefit too.
Yeah, and we'll be a little more liberal going outside of Pennsylvania because our rate is so low. If we have trouble with inventory and trouble finding quality Pennsylvania munis. Yeah. Well, let's kind of keep going down the path on the portfolio construction side and talk a little bit about, the pros and cons, or just the interplay between capital gains income versus dividend income. We kind of nibbled around that a little bit earlier, but capital gains rates are pretty attractive, right?
Yeah, so capital gains and dividends are the two main forms, and interest are the three main forms of investment income. Capital gains by far are the most privileged. So dividends and interest are charged at what your normal tax rate is, your ordinary income tax rate. So if you hear people say, I'm in the 22% bracket, I'm in the 24% bracket, 37, wherever you're at there, dividends and interest are taxed at that rate along with all of your other income. Capital gains are carved out and have a special tax code just for them, and you pay either 15 or 20% or 0% if your income is low enough to qualify for that bracket. And so I've had clients before who have no other income, and they could take capital gains at 0%, which is fantastic. And so you're realizing the cash, you get to sell the asset, and you pay nothing. And the next level up is 15%, which for most people is still lower than what their ordinary income tax rate is going to be. Typically, my clients are in 24, 35, 37, somewhere in that range. So to pay capital gains taxes at 15% is a great deal.
Yeah, and the brackets you're talking about for income are their highest marginal bracket, but even those capital gain rates are going to be attractive relative to your blended tax rate, correct?
Correct. Yeah, you know, if you're in the 24% bracket, your blended tax rate, if you just take the amount of tax that you pay divided by your income, is still going to be higher than 15 or 20% in a lot of cases. And so the capital gains rates are massively preferential if you could classify income that way. And that goes back to the benefits of having the non-qualified brokerage account money. You know, IRAs count as ordinary income. If you take $300,000 out of your IRA in a given year, you're paying tax at your marginal tax rate on that $300,000 in income. The brokerage account, we have a lot more flexibility. Depending on what the market does in a given year, let's say we have some losses and we were going to tax loss harvest anyway, we could sell the positions that are down and net you a loss and give you the cash. And so you would pay no tax on taking money out of the portfolio in that instance. You would actually get a deduction. And so we have some flexibility in the way that we take money out of those accounts, depending on which particular assets are sold.
So even if we haven't kind of dollar cost average our gains over time, like we talked about initially, if you've got an after-tax account that is just very, very low cost basis, very, very high unrealized gains, realizing those gains is, all things being equal, going to be more attractive than the earned income caused by an IRA distribution.
Yeah, exactly.
Yeah,
right. Even if the gain is 100%, that your basis is zero, which it's always higher than that. But even assuming you're paying tax on the entire amount that you take out, it's still less than it would be if you were taking it out of, say, a 401k or an IRA.
But best case scenario, we've been doing a good job over the years, and we've got a very reasonable amount of gain to realize in that after-tax investment account. If we can take, some of it out of some of it out of the IRA, we kind of create this blended rate where if it all came out of an IRA, maybe we're looking at a 24% tax rate. Maybe we can do that at 12 or 15% using some of each bucket.
Exactly. And what I've seen too historically is if we could manage that over time and that we dollar cost average the gains, we tax loss harvest every year, we could keep the taxes somewhat similar every year. That way you're not having spikes in your taxes so that one year you realized 100,000 in gain, the next year you realized 20,000. We want to keep that relatively even so that over time we're hedging against changes in the tax code also.
Yeah. Well, you've mentioned tax loss harvesting a couple of times, so let's talk about that a little bit. And I know we go to a tremendous amount of effort every year in tax loss harvesting. I know 2022 was a big year where you saw both the stock and bond markets down double digits, and we were determined that clients on top of that weren't going to see a big tax bill. But tell us just a little bit about, the real, the biggest advantages and kind of how we go about the tax loss harvesting.
Sure. The best way that I could explain tax loss harvesting is to just use a basic example. So let's say Brad and I are two investors. We each invest $10,000 in Apple. 1 year from now, Apple goes down, and now our $10,000 investment is now worth $7,000. If I sell my Apple position, I've realized a $3,000 loss. Brad doesn't do anything. He still has the $3,000 loss on paper, but he hasn't realized it yet because he didn't sell. I wait the 30 days. So when you sell a stock at a loss, you have to wait 30 days to buy it back if you want to capture the loss on your taxes. Let's say I do that and it doesn't move at all during that time. So I buy back in at 7,000. It's now gone back up to 10. So we're back where we started. We invested 10, it dipped to 7 for a moment. I sold at the bottom, bought back in at the bottom, and went back up to 10. Brad just rode the roller coaster all the way through. And we're both now back at $10,000 where we started. The difference between us in these two situations is that I get to claim that $3,000 loss on my tax return against my other capital gain income. Brad does not. And so over time, the compound effect of that is I can accumulate a lot of losses as the stocks move, which they do move. But if our plan is to hold Apple for 20 years, 15 years, someday that position is going to be worth $60,000. And so if you want to sell it then, you have a massive gain. But all the while, I've been adding up these little losses as it moves. And so I'm going to pay less in taxes over my investing life than Brad is by just doing nothing. And so that's really, I think, the best way to understand where tax loss harvesting comes in. It's a strategic way to capture these little losses as the market moves. And our asset management team does that every year. They're always looking to see, does it make sense to tax loss harvest this position right now? And they'll swap in another position to kind of hold the place of that. So the classic example is if you own Coca-Cola, you could sell the Coca-Cola stock, buy Pepsi for 30 days. They're generally going to move together. So if one of them goes up, the other one will go up and vice versa, and then you swap them back 30 days later. Another thing you could do is just buy an index. So you sell Apple and you buy the NASDAQ index, which contains Apple. And then 30 days later, you switch it back. And so it's kind of a tax trick as you go along that the stocks are going to move anyway. It allows you to capitalize on the fact when they go down.
And I think the other point, Ian, is that, we're not going to do it for every single position where there's a loss at the end of the year. It's got to be significant enough that it makes sense to take that action. The other issue is we don't want to be in a position where we've almost liquidated an entire portfolio to then rebuy it back. So there is some discernment as far as, how much bang are we going to get for each one of these harvestings. But yeah, exactly. I think that's a great point.
Yeah, in my example, I think that's a good example of a real life scenario that we would do that. You invest 10,000, it goes down 30% to 7,000. If it goes to 9,800, it's probably not worth doing it, because then you have to look at the transaction movement, and what if the day that you sell, now it's down to 9,700. Once it gets too minute, it doesn't make it worth it anymore. But that's something that our asset management team's always looking at to see, is the juice worth the squeeze on this? And when it is, they'll do that.
And the other thing you mentioned very, very briefly, which is important, is if we have, the opportunity to realize more losses in a given year than there were gains, 2022 being a great example, because that was just a tough environment. Those losses that we harvest, they carry forward forever. There's no expiration date on those. So we want to, when we have that opportunity, make the most of the opportunity, not just enough to get us to zero for that year, correct?
Correct. And those losses can offset other types of income too. So in any given year, you could offset your ordinary income from wages, from dividends, from IRA distributions by up to $3,000. So assuming that you've already offset all the capital gains that you had that year, you could go $3,000 further to offset other types of income. Other types of capital gains income also qualify. So let's say you made a lot of money on your house, or you have a rental property that you want to sell. I've tax loss harvested accounts before for clients who say, I bought this rental property in 1995. I don't really want to be a landlord anymore. I'd like to sell it, but I'm afraid of the taxes that are going to happen when I do sell it. Tax loss harvesting is a way to offset that. And so we could make some movement in the portfolio to help mitigate some of the taxes that are going to be caused by that property sale. And so all of that interacts with each other on the tax return, and it just ends up being a net benefit to you versus the example I gave where Brad buys the stock and does nothing.
Yeah. All right, so we've been talking a lot about how to avoid or reduce taxes. And while this may seem counterintuitive, what are there situations where there's advantages to realizing gains, to raising your hand and say, I want to take that gain and pay the tax on it?
Yes, and I think this goes back to the same kind of concept of diversification, or the same kind of concept of averaging out your tax bill over time. You don't want to be in the position where you bought IBM in the 90s and you still own IBM and it's almost all gains, or you bought Intel, or you bought any of the companies of that time that would have been a good investment and had been up till now, but now it's difficult to get out of them. How do you unravel this position that you've had for a long time? It has a massive gain, and maybe we don't necessarily want to own it anymore, or maybe we want to be more diversified than having, a large portion of our wealth in this one company. Well, if you have a large gain, it makes it more difficult to unravel it at once, because as you sell, you're going to pay the taxes now. And so selling a little bit over time, or taking some of the wins off the table as you go, allow you to mitigate that so that you don't end up in the position that you have an 80% gain in one position that you can't really get out of without paying a lot of taxes.
Gotcha. So I think there's two things. So if you don't want to get yourself into the situation where you've got a problem of too much unrealized gain, they always say the best way to get out of a hole is to either stop digging or never get into the hole in the first place. But the other thing I heard was, just from a prudent portfolio management perspective, you don't want to get yourself caught with that huge concentration. And this is one of those situations, I think, where, the investment decision probably trumps the tax decision. And we've had a ton of situations over the years. Probably the most extreme is one client who probably, if they weren't willing to start to unravel this hugely concentrated position, they weren't going to be able to become a client. There wasn't enough other money there. And long story short, it was not long after we had agreed to do this, came up with a plan, did it in a very reasonable fashion while we were working with their accountant, along the way, that stock became virtually worthless. And, they said, my goodness, you guys are geniuses for telling us that. Well, no, we're not geniuses. That's pretty basic. Let's not have one position be 80% of your portfolio. But I think that's kind of the other side of it. That's not the tax side of it, but that's one of the unintended outcomes.
I think that's a good point to bring in, that you don't want the tax tail to wag the investment dog either. It works the other way around. And in thinking through all these strategies that we're discussing today, at the end of the day, our goal is to end up with the most amount of money as possible. Saving money in taxes aids you in getting there, but making decisions to save taxes that don't aid the wealth building part kind of defeats the purpose of what our goal is. Sometimes it makes sense to pay the taxes. If you made a lot of money, you're going to pay a lot of taxes. And if you made no money, you pay no taxes. And so sometimes it still makes sense to take the gain. It still makes sense to make the additional dollar, because our end goal is, after we've paid Uncle Sam, how much do we have left?
Yeah. Paying taxes is it's a good problem to have.
And we could mitigate it as much as possible, but sometimes some of the strategies to mitigate taxes will start to cut into the investment returns and become counterproductive, where you would actually make more money. Like with the corporate bond example, you would make more money if you just got the taxable version and paid the taxes.
Right.
Even after paying Uncle Sam, you still have more.
Right. So let's talk a little bit about Roth conversions. There's been, it just seems like an ever increasing number of articles written about them lately. At a high level, just what are the biggest pros and cons?
Sure. I think the first place to start when thinking about Roth conversions is to understand the two different types of IRAs that you could have. You could have a traditional IRA, also called a pre-tax IRA. You get a deduction for putting money into this account, and then you don't pay taxes as it grows, and you pay tax on the amount that comes out. So let's say you put in $5,000. Over time, it's invested. It's now grown to 10. You withdraw the 10,000. You get a deduction going in at 5, and you pay tax coming out at 10. All along the while, in the meantime, you've paid no taxes on the growth, the dividends. It's deferred. Tax deferred is another term that you'll hear. With Roth, it works a little bit differently. You don't get a tax deduction when the money goes in. So you pay taxes on that money that day, and then it goes in the Roth account. This is a tax-free account. And so as it grows, you put $5,000 in. As it grows to 10, you could take the 10 out and pay no tax. Generally speaking, that's going to end up being a better deal than the reverse, because in the traditional IRA, you get the tax deduction up front, but you pay tax on the higher number when you take it out. With the Roth account, it works it the other way around. You pay tax on the lower number when you put it in, no tax on the higher number when you pull it out. And so one of the strategies that you could do is what's called a Roth conversion. You're converting some of the assets in your pre-tax IRA to a Roth IRA, paying tax on it while you do the conversion. And the benefit of doing that, one, is that the government is very protective of Roth accounts. There are income limits to who can contribute to a Roth account. There are contribution limits to how much you could put in per year. It's a very restricted account. And so generally speaking, you can only put a couple $1,000s in a year. Unless you're over the income threshold, then you can't do it at all. And so Roth conversions can come in at that time and allow us to get more money in the Roth that you wouldn't be able to otherwise.
So if we think about it from a fact pattern standpoint, and you know, the biggest negative I see with the Roth conversion, the Roth IRA seems like a great tool as we're going, because we're paying tax on just a little bit of money as it goes in each year. It's not a huge problem. But when we get to the conversion, now we're talking about converting, you know, 10, 50, $100,000 of Roth. There's a big tax bill. And I guess I always look at it as almost tax arbitrage, where, you know, the ideal fact pattern in my mind has always been, you've got a client who has more money than they know they're going to spend in retirement. They know they're never going to spend all of this. They have adult children who are very high income earners, and ideally we're very low income earners. You know, we probably haven't started our required minimum distributions yet, may or may not have started Social Security, largely living on that after-tax account we spent so much time talking about early on, that we can get dollars into an account that our high income earning kids aren't going to pay tax on. Is that fair?
Yeah, I think multi-generational tax arbitrage, which is what you're describing, is a good use case. Even within your lifetime, tax arbitrage is a good use case. I've had many clients whose income dips for 1 year or two. You know, let's say they have a gap in their career, or they have a gap between retirement and starting to take Social Security, where their income for 2 or 3 years drops down to $20,000 on paper. That's a perfect time to do Roth conversions. Throughout your career, you were probably in the 24% tax bracket. You retire, you drop down to, let's say, the 10% tax bracket. Well, if you do Roth conversions when you're in the 10% tax bracket, you're only paying 10%, or the next bracket up is 12 on the money that you convert. If you could choose to pay 10% today and never pay tax on the money that you convert again, that's a fantastic deal. Because as soon as Social Security starts, as soon as you're required to start taking money out of your traditional IRA and 401k, you're never going to be in the 10% bracket again. And so taking advantage of that while you're there is a great way to arbitrage even within your lifetime. You know, I have a temporarily low tax rate. And so what can we do now to take advantage of that so that later I could pay less?
Yeah. Now, what if there's somebody who, let's say they don't have children, their assets are all going to go to charity when they pass. If they've got assets that they're not going to use during their lifetime, it doesn't seem like it would make sense to raise your hand and say, I want to pay these taxes early.
Yeah, in that case, it wouldn't. I mean, Roth conversions are a case-by-case basis, whether they make sense for you or not. There's a lot of times where we could look at the situation and say it actually makes sense to leave it where it is. That the example Brad gave is the perfect one. If you want to leave your IRA to charity, the charity doesn't pay tax. And so there's no need for you to raise your hand and pay the tax for them. Just give the IRA to the charity, they could cash it out. They don't pay tax at all.
All right.
And so really on a case-by-case basis, Roth conversions may or may not make sense.
Okay. So one more question before we leave the Roth. When you do pay the tax, because again, there's a big tax bill that comes with that. Tell me a little bit about paying the tax out of either earned income or out of after-tax investment assets versus paying it out of the IRA itself.
Sure. So when you do the Roth conversion, there's a couple options, which Brad alluded to, that allow you to send the money to the IRS. The one that unfortunately is probably the most common is withholding it from the IRA. And that's going to be the least favorable option. So let's say you wanted to convert $80,000 and you're going to pay 10% in tax just to make it easy. You're going to need to send $8,000 to the IRS. You could take the $8,000 out of the $80,000 that you're pulling out and send that to the IRS so that $72,000 goes into the Roth instead of $80,000. $8,000 goes to the IRS, $72,000 goes to your other account. The problem with that is we are now paying tax on money and not getting it into the Roth IRA, which was the goal. And so if you have outside savings of cash, if you have the non-qualified brokerage account that we spoke about before, if you have active income coming in the door, you're still getting a paycheck and you could use that money to help fund the tax bill that year. That's going to be more beneficial because it allows you to get more money in the Roth. Once you take it out of the IRA, you can never Roth convert just cash you have. And so it's kind of giving up an opportunity that you have available to you and using it to pay taxes. We would never suggest that you take money out of your Roth IRA to pay taxes. And that's effectively what you're doing if you withhold it from the conversion.
Perfect, perfect. Well, let's change gears a little bit and talk about charitable giving and how that impacts things from a tax perspective, and also some of the things that are available inside of portfolios. And I'll maybe ask you to rank a couple of different things. So you can, at the simplest level, you can just give a charity cash, just write them a check out of your checkbook. You can give them appreciated stock. You can use a donor advised fund or some sort of a foundation. I know there's the Pittsburgh Foundation out there. We've got the Foundation for Enhancing Communities locally. And then you've got qualified charitable distributions. Just kind of walk us through those four and, kind of how do you rank them? Sure.
I would think the cash is the least favorable option. We'll go that direction. There's with these other options, there are ways that you can use assets that you already have on the books. Cash is potential invested money that you could buy in at today's prices. So let's compare that to appreciated stock. Let's say that you've owned, in the example that I had before, you bought IBM in the 90s. You still have it. It's worth a lot of money now. And you're charitably inclined and you plan to give to charity anyway. Or let's say you donate to your church, frequently or regularly, and you just write them a check or you give them cash every month, or you have an online recurring donation through your credit card. Why don't we give them IBM stock instead? You could still give the same amount, but instead of giving away cash that you could use to buy new investments or fund new investments today, we could give away the stock that you're maybe over concentrated in, has too much of a gain, doesn't make sense for you to sell. And it's the same kind of logic of giving your retirement account to charity. Let's give the church IBM. They sell it, they don't pay taxes. Any nonprofit doesn't pay taxes, so they're happy to receive the stock as your donation. You still get a deduction on your taxes for the value of the stock the day you donate it, but the benefit to you is you don't have to pay capital gains to make that transaction. We could just transfer the stock to the charity. And the other vehicles that Brad gave are options to combine with that.
Can I just jump in real quick before we leave the appreciated stock? We do see occasionally situations where clients don't want to reduce their investment portfolio, right? They say, no, that's money for retirement, or that's a position that I want to hold because it was given to me by my grandfather, or what have you. Oftentimes clients will say that $10,000 gift they want to make, if they do have the cash, they'll just put that $10,000 into the portfolio, gift the appreciated stock. So we haven't devalued the retirement impact, or we can put that $10,000 right back into that stock, but now we've reset the cost basis.
That's a great point. Yeah. Even if we buy the exact same position again, you're in the same position, but you've reset the cost basis, so now your gain is less.
Yeah.
And gifting appreciated stock can be used in conjunction with a donor advised fund, which I'd say is probably the next level up. And what a donor advised fund allows you to do is front load your charitable contributions. So let's say you regularly donate $10,000 a year to charity. This has been a consistent practice of yours. You plan to do it into the future, indefinitely. You could pre-fund a donor advised fund, let's say with $50,000. So you get a $50,000 deduction in 1 year versus taking 10 at a time. But with tax planning, you could decide which year you want to do that. And so oftentimes clients who have, let's say they receive a large bonus, they sell a property, they have an exit from a business, whatever liquidity event causes their taxes to go up in a given year, maybe that's the year we fund the donor advised fund. So then you get a tax deduction in one of your highest tax years, and then the donor advised fund is available to you. It could be invested, and you could just direct Charles Schwab, who would run it, or who would be the custodian, to send a check to the charities that you want to get the money. And it allows you to front load those deductions so that we could be more strategic about when they're taken. And then the best of these examples, the best way I think to give to charity, if it's an option to you, is to use qualified charitable distributions from your IRA. And so you have to be 70 and a half to qualify to do this, not 59 and a half, which is the age just to take money out of the IRA. But what it allows you to do is donate money directly out of the IRA account to the charity. So it would go from your Schwab or Fidelity account, send a check to the church, send a check to the nonprofit, but it counts against your required minimum distribution when you reach the age where you have to take money out of the IRA anyway. So let's say that the IRS tells you you need to take $50,000 out of your IRA this year regardless, because you've hit required minimum distribution age. That's how that works. But you want to donate $20,000 to charity anyway. Great. You could just use 20 of your 50,000 required distributions and make that part charitable. And then you don't pay tax on withdrawing that amount of money out of the account.
And you also get to double dip on your standard deduction, because I'm seeing since, that went up in 2018, and almost, went up, almost doubled. That fewer and fewer clients are itemizing, so that cash gift, you have to be able to itemize to get any benefit for that whatsoever. But your qualified charitable distribution, you get out from under the tax and you still get your full benefit of the standard deduction.
And typically it would coincide with being more fully retired, which typically people would want to pay off their mortgage. So that eliminates another item that would be a deduction on your tax return. Maybe you downsize properties, now you're paying less property tax. Your income goes down, so there's less state and local tax to deduct. There's a lot of compounding factors that would limit your ability to itemize anyway. And so being able to take the charitable deduction regardless of what happens elsewhere, like Brad said, you could double dip, take the standard deduction and your full charitable deduction and not have them overlap at all.
Yeah. And just one point before we leave this, and Ian, you alluded to this, but just to really be clear about this, all of these are charitable giving strategies that have tax benefits. These are not tax planning strategies with charitable benefits. If you don't have that charitable intent, these are not for you.
Yeah. I mean, if the only reason that you're making the donation is to get the tax deduction, it still doesn't make sense from a wealth preservation standpoint, because let's say you save 20% in taxes by donating to charity, you're still out the 80% of money that you gave to the charity. But if you're going to give the money away anyway, it's better than being out 100%. You get to save a little bit, and it allows you really, in effect, to maximize the amount you're giving away. It's the government is subsidizing your charitable intent. But if the charitable intent's not there to begin with, it doesn't make sense to go down that road, because you'll still have less money than you would had you just done nothing.
Right. Ian, I want to make sure we leave a little bit of time for Q&A, but just one more topic I wanted to make sure we touched on. Are there, at a high level, are there any options available for a business owner that doesn't apply to a traditional employee?
Yes, yeah, business owners and really real estate professionals are the two classifications in the tax code who have the most flexibility, the most special treatment. Employees, just you could contribute to your 401k or you could not contribute to your 401k. There's not a lot of other tax planning, at least from that income stream, available to you. Business owners have a lot. The way that the business is structured, you could set up a retirement plan for yourself. You know, are you a partnership? Are you a corporation? Do you have a pension that you could set up for yourself? How much do you want to contribute to that? These are all questions that if you're a business owner, we could walk through with you on a case-by-case basis to see what makes sense. But there are tons of options for business owners in the way that you receive income, how much you want to take out of the business every year, what salary do you want to pay yourself. Each one of those decisions will impact how much you pay in Social Security tax, how much you can contribute to your 401k, how much shows up as business profit versus wages. There's a lot of moving parts with business owners. There's a lot of moving parts with landlords and people who own rental real estate. And really, those are the two most favored categories that there are a lot of planning opportunities that we can kind of maneuver around to see what makes the most sense in a given scenario.
Yeah. And before we jump on to the Q&A, I will just say, despite all the conversation we just had about tax planning, we're not CPAs. We don't do taxes, but we do an awful lot of collaboration with CPAs and with our clients and attorneys, and we're happy to work with your CPA. One of the things that we find most typically is that when you get professionals from different disciplines collaborating, investment advisors, attorney, accountants, we get a better end result because we're all coming at the world from a little bit of a different angle. And we could bore you with story after story about that. But there was one that does come to mind where at the end of the day, the solution for the client was it was going to be cheaper to pay the interest and the penalty on under withholding throughout the year than it was to essentially take all the money out of the IRA, which would have avoided the penalty. And the accountant never thought of that. But because we were collaborating, we probably saved the client $10,000 or $20,000.
Yeah, and we're happy to have conversations directly with your accountants and CPAs. If you're looking for a new accountant or CPA that might be more appropriate for your situation, we can match you up with accountants that we know who would be a good fit. I have conference calls regularly where I speak with the client and their accountant at the same time, and sometimes that eliminates some of the lost in translation information that we could kind of tell the accountant, this was our thinking on the investment side. So that way they hear directly from us where we wanted to go and what the cause of that tax strategy was, so that they could make sure they're reporting it on the tax return the way it was intended, and vice versa. There's a lot of times where accountants can inform us, hey, this client has a $400,000 loss carry forward. Well, that changes our investment strategy a lot. Now we don't have to worry about capital gains because we have a $400,000 budget to reallocate this portfolio. So really the back and forth communication between us and your CPA will end up having a better result in the end.
Yeah. And we did get a few questions here. We'll try to get through as many as we can. This one's pretty straightforward. Can your inherited IRA be used to meet the requirements of the required minimum distribution for personal IRAs?
No, they're separate, unfortunately.
Okay.
And yeah, depending on when you inherited the IRA, there's a bunch of different regimes of how you have to take the money out and what that timeline looks like.
All right, this is another, I think, pretty straightforward one. This person is turning 73 in December, which is the new required minimum distribution age. They want to take a distribution prior to the month they turn 73. Would it apply to their required distribution, or do they have to wait until after they turn 73?
It's the same tax year though?
Same tax year. If they turn in December, I'm guessing yes.
Yeah, I would assume that that would count. We would want to check with the CPA just to make sure how that's reported, but it would show up on the same year's 1099.
Yeah. I believe your RMD you can take anytime during that calendar year in which you have to take it, but that qualified charitable distribution that we were talking about at 70 and a half, you do have to physically cross that 70 and a half marker to be able to do that.
And a good point there too on the qualified charitable distributions, on RMDs with Roth conversions. I've done Roth conversions with clients before who are in the phase of taking RMDs. You could do that, but you have to take the RMD first. And
Right,
so
you can't use that to do the conversion.
yes. Yeah, you can't convert the required amount is what I'm saying.
All right, Ian, here somebody's asking you, in your example with the Apple at 7,000, they're asking, wouldn't you also pay capital gains when the stock moves back up to 10,000? So isn't the gain from harvesting that loss neutralized? Maybe.
That's a good question. And it is, if you end your investing life at zero, it is neutralized. But what ends up happening in effect is that we're just deferring the gain into the future. And every year that you can defer the gain gives you another year to make it up for it in the account growing. And so if I could pay, let's say I owe the IRS 10 grand. If I could pay them 5 years from now versus paying them right now, that's a better deal for me. That gives me 5 years to make $10,000 more. That gives me 5 years to invest the money. It could sit in the money market and just earn interest during that time. So however I could push taxes out into the future, hopefully indefinitely, is a better deal for me than paying them today. And so that is true that it would be neutral if we liquidated that position in total and you end with $0 in your account, but typically that's not going to happen, and that likely your children or family beneficiaries will inherit those assets, and then the tax basis gets stepped up anyway.
I think we have time for one more. This is somebody who wrote in asking about Roth conversions with Pennsylvania 529 plans. I'll take a stab at this. There is no Roth in a 529, but the Secure 2.0 did allow for the rollover of unused Roth dollars into Roth accounts for those beneficiaries. Correct?
Yes.
Okay.
Yeah. So you can contribute up to the Roth limit and kind of chip away at the 529 over time, which is a new provision. And that's a great provision, because that's one of the fears people have about using 529s is, what if I have extra money in here? How do I determine exactly how much to save? Well, using this Roth strategy allows that. You kind of have a backdoor out, that if you don't need the 529 money, you could convert it to a Roth through this method.
Yeah. It used to just be, well, you save it for grandkids and, et cetera, on down the line. So excellent. Well, I think we had a really good discussion about this to kind of wrap it up, and kind of how can we help you, all the attendees with this. We kind of mentioned this a little bit as we went, but this is such a personal area. If some of the questions in the Q&A didn't lend themselves to a mass discussion in the group, reach out to us, let us know. But please just know that we've got the resources in-house, and also in working with accountants, with tax attorneys, to either deal with some of the questions that were raised today, or at least get you pointed in the right direction. So with that being said, Ian, I don't know if you want to bring up the slides again. We hope that you had enjoyed the webinar. I hope the content really, hit the mark for everybody. We do have an upcoming webinar in, I think it's March 19. Corey Phillips and Daryl Patton are going to talk about what happens to your money when you die. That's always a good topic. You can sign up for all of our webinars at our website, fortpittcapital.com. We need to get to our disclosure page. There we go, to make sure we're compliant. But thank you all for joining us today. We really
thank you.
enjoyed being with you.